Hello fellow traders, welcome back to our channel where we learn how to make money in the world of finance and trading. Today we'll be talking about call options through the lens of this highly acclaimed book, Options as a Strategic Investment by Lawrence G. McMillian. We're going to be focusing on the first part of chapter 3, which is all about how call buying works and how Delta can help you choose the best call to buy. I'm taking notes on the entire book and compiling them into easy to digest videos. I made sure to include examples from the book in case you want to see how the numbers break down. Whether you want to enhance your trading skills or simply curious about the power of call options, this video is for you. Feel free to hit the like and subscribe button if you enjoy this type of content. With that said, grab a notebook if you want and let's get into it. Call buying is generally considered the easiest form of option trading to understand. However, making money buying calls can be much more challenging than shorting them. Your success as a call buyer depends on how well you're able to select stocks that will go up during a specific time frame. This strategy is best used when you're very bullish on the underlying stock in a short-ish time frame. Traders love buying calls for 3 reasons. Calls have the potential to make large percentage returns from only a moderate rise in stock price. The second reason is you can only lose a fixed amount of money, that is the money you spent buying a call. The third reason is that you can add some potential upside to your portfolio by using calls to buy a specific stock at a certain price without missing the market. Remember, calls give you the right to purchase shares at a specific strike price. Let's look at how call buying works using an example from the textbook. XYZ is currently trading at $48. A trader buys a 6-month out July $50 call for $3 a contract because the trader believes XYZ will increase in price to over $50 by expiration. If XYZ rises 20% or $10 in less than 6 months, the July $50 call that the trader purchased should be worth at least its intrinsic value of $8 a contract. The profit from this trade would be $500. That is $800 from the options sold before expiration, minus $300 for purchasing the call. This works out to a 167% return on only a 20% move up in stock price. Pro tip, don't risk more than 15% of your capital in call buying due to the large risk of realizing a max loss on your calls. Remember, you will most likely only profit if the stock rises in price fairly quickly. Alright, now that we know how call buying works, let's look at one of the most common mistakes when it comes to buying calls. I see this all the time in trading forums. Someone will ask why their call isn't going up even though the stock has gone up in price. In short, they bought the wrong call for the right stock. So how can we avoid this? How can we choose which call option to buy? Let's go over how to select the best call step by step. Since upward momentum in the underlying stock is your best friend, choosing the right underlying stock is the most important choice you must make. The second most important decision you need to make is your timing. That is, how long it will take for your price target to hit. When it comes to timing, the book says that technical indicators will most likely outweigh fundamentals. This is because even if a beaten down stock has positive fundamentals, it's hard to predict how long it will take for them to be reflected in the price of the stock. For step 3, based on your stock selection and technical indicators, decide which expiration to buy. This is essentially your time horizon. The final aspect of choosing the best call is deciding between out-of-the-money calls or in-the-money calls. Out-of-the-money calls are generally riskier but offer more potential reward than in the money. Pro tip, don't choose out of the money just because they are cheaper. If you can only afford the cheapest calls on a particular stock, the book advises you not to speculate using calls. To make sure we're staying on topic, we're going to gloss over steps 1 and 2, and this is because the book doesn't get into which stocks to buy options on or which technical indicators to use. If you're using more advanced trading strategies like call buying, you need to already have a good stock selection process and a good technical indicator strategy down. Another thing I want to add is that steps 3 and 4 are married to each other. How far out you buy your option and how much you expect the stock to go up is going to dictate whether you buy in the money or out of the money. With that said, the general rule when buying calls is this. The shorter term the strategy, the higher the delta value should be on the option you decide to buy. Real quick, if you don't know what delta is, in options trading, delta is just a function of how much the price of an option is expected to change in relation to a $1 change in the price of the underlying asset. In other words, delta represents how much an option mirrors the underlying asset's price changes. A call option with a delta of 50 indicates that for every $1 increase in the underlying asset's price, the call option's price will increase by approximately 50 cents. Delta changes as the underlying stock price changes. As the stock increases in price, delta values for call options will increase in value, and as the stock declines in price, delta will decrease as well. So let's say XYZ is currently trading at $47.50, and the call buyer expects a quick but possibly limited rise in price in the underlying stock. Should he buy the $45 call or the $50 call? Delta values can help you decide which one to go with. Here we have the choice of two options. The first one being the July $45 call, trading at $3.50 with a delta of 65, and the second is the July $50 call, trading at $1 with a delta of 25. If the deltas were to remain constant, which doesn't really happen, but for the purposes of this example, which call is the better buy if the stock rises to $49? A $1.50 rise in stock price would result in a 97-cent increase for the July $45 call price. That's price increase times delta. Alternatively, you could expect to see a 37-cent increase on the July $50 call. Consequently, the July $45 call would have a 25% return, while the July $50 call would have a 37% return. The out-of-the-money July $50 call would appear to be the better choice in terms of percent return. However, out-of-money calls don't always result in a better return. Let's look at what the book says when it comes to which options to buy across different styles of trading. For day trading purposes, it is advised to buy calls with the highest delta value possible. Technically speaking, the underlying stock has the largest delta of 1. Often it may be more profitable to trade the stock instead of the option. What makes options difficult in the near term is their wide bid-ask spread as compared to the stock itself. Day traders need to capture a small part of the stock's move, and often at-the-money or out-of-the-money options won't respond well enough to those movements. Basically, if the delta is too low, there just isn't enough room for the option day trader to make money. If you want to day trade options, short-term in-the-money options should be bought with the highest delta possible, preferably around 90 or greater. Suppose you expect to hold an option for a week or two, again, the higher the delta, the better. You should still buy in the money because it has the highest delta and will respond more closely to the underlying stock. Ideally, delta will be 80 or higher. If your trading strategy has a great timing record, owning options with high delta values will help you capture the most points and gains. As the time horizon lengthens, it is appropriate to use an option with less delta. This generally means the timing of the selection is less exact. For trading strategies that don't require exact timing, a lower delta option may outperform. However, even if you're holding an option a few weeks or months, in-the-money options can still be used with a delta ideally around 70 or 80. Generally, out-of-the-money options are not recommended, but for very long-term strategies, you could buy slightly out-of-the-money or even at-the-money calls with a delta of 60 to 70. A lot of new traders look at in-the-money calls as being too expensive or that they already reached their max profit, but the reality is that in-the-money calls often have a higher chance of making money than out-of-the-money calls. In the next video, we'll discuss how volatility can help you decide which call option to buy. In case you didn't know, McMillian is also a content creator on YouTube. I've linked his channel in the description. Thanks for watching, and remember to trade gingerly.